Morning, everyone. I'm Dan Johnson. I'm a partner in the Stamford office at Cummings and Lockwood. And this morning, I'm going to talk about planning in anticipation of the gift tax sunset. If you've been to this before, even if you've never been to this before, you would notice that we're recording it. We record this every year, and then we cut the individual sessions and we put them up on our websites so that advisors and clients and prospective clients and my friends from college can watch them whenever they want. And so the reason I mention that is because it's on our website, we're able to keep track of who's looking at, not the identity of the people who are looking, but how many people are looking at these videos every year. And so I was disappointed recently when a member of the marketing committee came to me and they said, Dan, your video from last year didn't do so well. You actually got fewer views than Dan Fitzgerald. Dan Fitzgerald, the Family Feud guy? This person on a marketing committee said, maybe you should do something to spice it up a little bit this year. And so I spent a lot of time thinking about in 2023, where my goal is to get clicks, what could I do to get some more clicks on my video? And I think I came up with a solution a couple days ago. I barely know who that is. But what I do know is that when we had a surprise birthday party for my 7-year-old niece and we brought that out, she went bananas. And when she hears about this and tells her friends, Dan Fitzgerald is going to be toast in 2024. There's a reason we do this seminar at the end of the year. We're all tying up loose ends as we start to exit 2023. We're thinking about 2024, what opportunities should we have on our radar? And the nature of what we do, which is time sensitive and tax sensitive, is that we're going to give a lot of advice over the next couple of weeks. There's a certain urgency and intensity that happens over the next couple of weeks, peaking in my experience at noon on December 22nd, which is the Friday heading into the holiday weekend. And if you call me after noon on December 22nd, it better be really, really good. And the nature of what we do, and as a parent, it's hard to not carry back that advice-giving mindset back into the house. And so my son's least favorite dad joke is me saying, you guys are lucky because I get paid good money to give advice all day and you guys get it for free at home, haha. Now, they of course do what they should do, which is ignore me. There's one piece of advice that I think has landed with them, and that is in the spirit of the holidays, you're always being judged by everyone in everything that you do. Not a very holiday message, but you're always being assessed by people. And so I was looking at this list from a website called sayitwiththegift.com, and it's an interesting list. I mean, this list has a message, which is to drive you to use sayitwiththegift.com to give presents to the people you're giving gifts to. But what caught my attention about this list, and it's probably because of what I do for a living, is what's not on it. And I don't know if any of you have had the same reaction, but what's not on it is people do gifting to avoid taxes, to get money downstream and avoid exposure to the estate tax. And I wouldn't necessarily expect somebody who's working for sayitwiththegift.com to focus on that because of the way we talk about gifting as a financial exercise, a tax efficiency exercise. I think we tend to lose sight of the fact that some of these factors do come into play, benefiting the family, letting the family knowing that you're thinking about them. And that comes up in the will and revocable trust context too. Before I move on into the weeds of tax planning, this is my public service message. If you look at this list and you recognize yourself in any of these reasons that people are awful present givers, you're probably like me and you need to revisit your process. And I was watching Christmas Story the other day, and one of my favorite quotes from that is Ralph about his Aunt Clara, who says, Aunt Clara had labored for years under the delusion that I was not only perpetually 4 years old, but also a girl. And she's the one who gives him the pink bunny suit. All Hat No Cattle was an interesting one because that's the gift where the wrapping doesn't match up with the gift. And the article is kind of a funny article. The example in the article is someone who gives something that is not Tiffany jewelry in a Tiffany box, and that person breaking down in tears as a result. And I had an experience when I was little, I was about 10, and there was a big box for me for Christmas. And I thought, for some reason, I talked myself into the idea. I didn't ask for a TV, but I thought it was a TV. I convinced myself that it was a TV. And by the way, this is for the younger people. This is when TVs were boxes. And so I excitedly decided to open this present first. And I was about 10 years old again. And it was 2 bottles of red wine that were going to peak when I turned 18. And they were great, but that was a lot of delayed gratification for a 10-year-old. This list highlights, at the end of the day, it's about planning ahead, right? When you're giving gifts, when you're doing planning, in the estate planning world, it's all about planning ahead. And, we meet different challenges with our clients. One is the client who says, I'm done planning. They show up and it's a conversation about what else can we do heading into the potential sunset in 2026. And you have a client who says, listen, I've used up my exemptions from the federal and Connecticut and gift taxes and estate taxes, and I have plans to use my annual exclusion. So I'm done. I'm good on the planning side. But, you're a financial planner or you're an advisor talking to the financial planner, and you're able to easily identify assets that the client doesn't need, extra assets the client is not using for their ordinary expenses. And so that's a place where I think as advisors, we owe it to that client to say to them, there's a certain tax efficiency to giving money now and doing the hard thing, which is paying the taxes, as opposed to continuing to hold assets that you may not need and having them exposed to the estate tax in your estate. And I remember the first time I heard about this was in law school in the estate and gift tax course. And they said, the gift tax is tax exclusive. The estate tax is tax inclusive. I never really got that, but this is the example I use with clients all of the time when I'm having this discussion. And it's very simple. If you are a Connecticut resident, so you're exposed to the Connecticut gift tax in addition to the federal gift tax, so say a 50% rate for discussion purposes, your budget for this exercise is $3 million. And you say, I'm going to give $2 million to the kids. Again, I've used up all my exemptions, so it's all taxable gift. The gift tax bill on that gift of $2 million to the kids is going to be $1 million. If instead of doing that, I take that $3 million and I hold it until I pass away, now the entire $3 million is exposed to the estate tax. The kids are going to get $1.5 million. The tax bill, the other 50% is going to be $1.5 million. So it's a $500,000 swing just based on the way the taxes work. And if you've ever wondered, if you're looking at a Form 706, you would notice that one of the things you have to do is report gift taxes that were paid within 3 years of death. And the reason you do that is to discourage gifts in contemplation of death. The IRS is saying, you can make a gift in contemplation of death, but if you're paying taxes to do it, those taxes are coming back into your estate so that you can't take advantage of this trick. So it's a good one to have on your radar. I always say tax lawyers and tax practitioners give the best cocktail parties. And if you want to succeed at a tax lawyer cocktail party, you can get far using Section 2036 because it contains a bunch of rules that we all know in practice, but may not recognize that they come from Section 2036. One's a simple one, which is if you give away property, you have to give away the right to control distributions of that property. The second is that you have to give away access to that property. So the takeaway for planning purposes when we're talking to clients is we have to say, and this is a financial planning exercise as much as a tax planning exercise, give away things that you don't expect to need. If you're giving away this asset thinking, well, there's going to be a backdoor and I'm going to gain access to it, you have a potential 2036 A1 problem. So we want to make gifts. We can include escape hatches if we really need them, but don't make gifts thinking I'm going to retain regular use of this property. And the reason I mention that, I had the experience this fall twice in about a 10-day period where I was meeting with two couples and they both independently reached the same conclusion. Like, I get it. The exemption from the estate tax is $12.92 million this year. I want to use that up. So that's 13 for me, 13 for my spouse. So why don't we'll each make a gift of $13 million into trust and maybe they benefit each other. And then we're giving away about $26 million. And that means we're retaining about half of our assets. Now, the only problem as they're talking through this, and I haven't said anything yet, is that if I give away half of my assets, that means I'm giving away access to half of my income. So what we're going to have to do is make sure that in running these trusts, we're distributing that income back to myself because I don't want to reduce my taxable income as a result of these gifts. And that's where we have to jump in and say, this is not a good plan. If you're going into this saying my plan is to gift into these trusts and retain all of the income for me and my wife, that is a direct 2036 A1 problem. You cannot go in saying, these are assets I can't afford to give away. I've had people who have fewer assets, not 50 million, 30 million, saying we're just going to give away basically everything. And so the problem, if we were discussing under 2036 A1 with the IRS in the event of an audit, what was the plan? The plan was they gave away 80% of their assets. They retained 20%, which is about $5 or $6 million, and they plan to live off of that and not touch the rest. That's not a credible argument. So that's kind of the upfront planning analysis. And then the backdoor or back-end planning analysis is you fund these trusts and you're distributing the income on a regular basis. And it was clear that the intention was always to retain the right to income from the gifted property. So be careful about that. This is just the rules heading into next year. So $13.6 million exemption per person, 27.2 for a married couple. What I'm focused on is that in this context, The exemption from the federal estate tax, if Congress doesn't do anything, will go down to a number. The number I use in meetings is $7 million per person, so $14 million for a married couple. So you have this extra exemption available. And as a couple of my partners have suggested, the only way to take advantage of that extra exemption, if the exemption does go down on January 1st, 2026, is to make a gift of, if the new exemption number is $7 million, somebody, one spouse, has to make a gift of more than $7 million before January 1st, 2026 to lock in the benefit of that extra exemption. So there's a lot of conversations happening now, starting to happen now, with clients who say, how are we going to use this extra exemption? What does the vehicle look like? What assets should I be thinking about? And I had an interesting one recently because it was somebody where it started out as an estate tax, let's make a gift of more than $7 million and use some of this extra exemption. And then for reasons related to the structure of the business, this client decided against it and to make a much smaller gift. And what we ended up converting over to was a 1202 intentionally defective, a non-grantor trust, where we went from an estate tax play to an income tax play, but again, with potentially very significant savings. You see slides like this from planners all the time where we're saying, if you make these kinds of gifts, if you grow it at 5%, if you have a 20-year window, the tax savings are tens of millions of dollars. It's 22.4. If the exemption doesn't change, it's like $29 million if the exemption actually went down to 7 million. And this is really just a story about the power of compound interest. And I would say many of you are much better at doing this kind of modeling than we are. I can run a straight line at 5%. That's not the best way to predict what's going to happen with the market. I know that for sure. And I think where the modeling is very helpful that you folks can do is saying to the couple or the individual, here's what this trust looks like in the future. Here's what your personal assets look like. When you see all of that, you get butterflies in your stomach about making a significant additional gift. If tax savings was the only objective, we could just do outright gifts to members of the family. But what we see is clients saying, this general estate planning desire of, I want to control how the kids receive the gifts. I like the idea of some retained access. I like the idea of asset protection planning. And I potentially like the idea of looking ahead through multiple generations. So in that context, the spousal estate reduction trust has really become the most popular tool in the toolbox. And when I say, what is it? What does it look like? It looks almost exactly like an insurance trust. If George Bailey is funding a trust for the benefit of Mary Bailey and their kids, Pete, Janie, Zuzu, and Tommy, thank you, yes. Then that trust is usually Mary's going to be the primary beneficiary. The kids are also all going to be beneficiaries. And during Mary's life, she can get distributions if she needs them. At her death, the plan for the kids probably follows whatever is already in the wills and the revocable trust. And potentially Mary could think about doing the same thing for George. She could set up a trust where George is the primary beneficiary, the kids are also beneficiaries, and George is the trustee. The one thing I want to highlight there is the concern about the reciprocal trust doctrine. And that says if George sets up a trust for the benefit of Mary and Mary sets up a trust for the benefit of George and they have identical terms and they're funded at the same time, in the eyes of the IRS, it's as if each of them created a trust for themselves. And so the IRS will uncross those transactions and bring all of those assets back into their respective estates. So that's a disaster, obviously. And so ordinarily what you see us doing when we have a couple who says we're inclined to both do spousal estate reduction trust, and by the way, SLAT, spousal lifetime access trust, is exactly the same thing, just a different term for the same technique. We say to those couples, here's the thing, we're gonna alter the terms of the trust. Like if George is the wage earner, we're probably gonna make it so that Mary has broader access to the assets in the trust for her benefit. George's access might be more narrowed, but the biggest thing we're gonna do is we're gonna say, one of these trusts is going to be funded now, and one of these trusts is going to be signed and funded at some point in the future. We're separating those two transactions from each other so that whoever is creating and funding the separate trust had an opportunity to back out of the deal. And the reason I want to mention that now, at the end of 2023, is if you believe that the sunsetting might happen and that there's planning to be done and that certs are going to be a popular tool with your clients, you're on the meter now. Right? And so what we see a lot of couples saying is, I want to spread out this funding by multiple months. And so this is one where you can't wait, forget about access to all of us, we have limited bandwidth to draft and create trusts in the second half of 2025. that's a known issue too. And there are trustees who put up gates about when they're going to review trusts. I mean, that happened in 2012. Some trust companies started saying, if you don't get us a complete document by December 1st, we're not going to be able to work with you. But the other thing is just saying, I want to spread these out as much as possible. And if we wait until the second half of 2025, now we only have 6 months. If we wait till the last quarter, we only have 12 weeks. So this is one where if you think there might be reciprocal trust, you want to get in front of it. And what I see couples saying on this front is, why don't, and actually it was an advisor who brought it up for the first time, why don't you, knowing this dynamic is out there, why don't you create these trusts? You're going to do some gifting anyway. You may not need to do, $13.6 million, but if you have some extra assets and you can get them off your balance sheet, why don't we just start this now, get the trust into place? We can make a relatively small gift. But now when we get to the second half of 2025, and hopefully at some point in that 6-month window, we have a sense of what's going to come out of Congress. If anything, if you decide to pull the trigger on a gift, the heavy lifting on the legal side is done. The document is sitting there. And now you just have the mechanical aspect of what am I giving and getting it into the trust, which can be done more quickly. So that's food for thought. Generation skipping tax, the name is always the problem that kids think they're being skipped. It's not. It's to benefit the kids. And to the extent they don't need assets, make sure that they pass as tax efficiently as possible to the next generation. When we're talking to a family and they say, we have significant assets, we recognize that the kids are going to get significant assets. And so we're starting to think about planning for, future grandchildren if we don't have any, or existing grandchildren in some families. How are we going to do this? And that opens the conversation to considering dynasty trusts. And, basically what's going on with dynasty trusts is historically there was a limit on how long a trust could last. The old law school rule against perpetuities. Basically, a trust can last 20 years beyond a life and being at the time the trust is created. So I always use 100 years in conversation purposes. A lot of states are revisiting the rule or repealing the rule. So in Connecticut, the rule against perpetuities went from about 100 years to 800 years. South Dakota has completely repealed the rule against perpetuities. New York actually still has the traditional rule against perpetuities. So the point of that is there are multiple jurisdictions. We see South Dakota a lot. We see Delaware a lot. We're starting to see Nevada. We see Alaska, jurisdictions that people are looking at. And it's easy, thanks to Steve Oceans, who's a high-profile trust and estates planner in Nevada. He creates this list every year, and this is from just a legal perspective. Where am I going to get good income tax benefits? Where is my family going to get good asset protection benefits if we set up a trust in that jurisdiction? And so the legal part of this is kind of easy to identify the favorable states. And then for most clients, it becomes an exercise of now, which trustee am I comfortable with in that jurisdiction? And is it one of these jurisdictions where they have an existing relationship with an investment advisor that can be carried into an existing trust company, or is it a client who's starting over with a new trust company? And that's the last thing I want to say about dynasty trusts is related to this, which is, clients find it very attractive. They say, okay, I'm going to go into one of these jurisdictions that I've never worked with before. And maybe I'm either working with a trust company for my current investment advisor, but I haven't had a lot of experience with them, or I'm working with a new trust company that I have no experience with. And, the people are charming and they seem sophisticated and they have a good track record. But all that being said, giving this new trust company the ability to make distributions to my family and giving them control over the investments that I have built up for the benefit of my family is too much. And so what a lot of these jurisdictions have done is put in a directed trust option, which says that the responsibility for the trust can be trifurcated. And so you still have a trustee in the jurisdiction, but that trustee can be taking instructions from an investment advisor selected by the family and a distribution advisor selected by the family. So it enables the family to go to a foreign jurisdiction, but have the substantive decisions continue to be made by their trusted family members and trusted advisors. And that goes as far as it is possible under 2036 to retain the ability to control investment decisions, even if you're the person who set up the trust. And so we see, particularly some of our financial services clients, this desire to say, okay, I'm going to give away the assets. Somebody else can be in charge of distributions. I'm going to go into one of these favored jurisdictions, but I still want to be in charge of investing the assets while I can. My partners and I are grateful that working with all of you is fun. You're very conscientious on behalf of our mutual clients. And we sincerely appreciate the partnership and the time that you set aside to join us every year here. So thank you for coming, and we hope that you thoroughly enjoy the holidays.